Hey everyone, Douglas here, and welcome back to the MMT Macro Trader and this market recap for Thursday, June 8th, 2023. And listen, we might have something bearish brewing, something bearish on the horizon that we need to take a look at. Hint, it's on the screen. We're going to do a little data science, see what we can glean from corporate taxes. But look, we're finishing out the first full week of June, and the rest of the finance world is completely focused on the potential doomsday scenario of the rebuilding of the Treasury General account. If you're on Twitter, you know that it has been all the rage for the last week or two to talk about the potential liquidity risk with the TGA build. And listen, for 3 hours last night during the MMT Macro live stream, we went into the deepest depths we could possibly get on the TGA, all things central banking, treasury, finance, corporate banks. We went into it all. We had a special guest, Ryan, from Applied MMT Podcast. Bijou, of course, was there. 3 hours. We covered it all. Look, sometimes our live stream gets a little off the rails. Not last night. It was 3 hours of pure MMT finance, MMT investing, MMT everything last night. We hit it all. Definitely check it out. But we fully debunked the TGA bearish scenario, laid it to rest. We're already seeing the TGA build happen, and everything the liquidity folks were saying would happen isn't happening at this point. And we think that will continue to be the case as the TGA continues to build. Check that out. Live stream last night on this channel. I'll link it in the description below as well. Again, 3 hours of nonstop MMT goodness. Check it out. With that being said, what I do want to talk about is something that as MMTers we know is one of the main ways, or one of really the two ways that net financial assets can actually be removed from the economy, and that is through a massive tax drain. Now, if you're an avid MMT trader, an avid MMT investor, at least invest from the framework of analysis of MMT, you understand what the drain is when taxes remove those net financial assets out of the private sector. The question is, what is the impact of that of that net drain, of that tax drain? And that is what I want to look at tonight. I'm going to switch back over to the code book here that I have, and we're going to just kind of dive into this data and see what we can make of it. Spoiler alert, I actually don't think there's any correlation between the tax drains and any sort of market activity following that event. But with that being said, because I don't want to lose you, obviously you could leave right now and you'd have what you need from this video. But I actually do think there is something bearish on the horizon that we do want to keep an eye out for, that will coincide almost with the exact same date as the corporate tax drain. That's going to be June 15th. That could end up putting a little bit of pressure on the recent massive rally that we have been seeing in stocks. So what did I do here? All right, you can see the corporate taxes here going back to 2000, starting in 2005 up until the beginning of this year. You can see that quarterly there's a massive spike in corporate taxes that are received by the Treasury. And so what I decided to do to kind of get at this from kind of a data science standpoint and see what we can glean is I decided to take every build that made it above the 30 billion mark and overlay and pull that out. And then what I did is I calculated the 2-week and 4-week forward return of the S&P 500 and then grabbed those returns 1 week ahead of that 30 billion peak and 2 weeks following to get a distribution of what the forward returns look like of the S&P 500 1 week prior and then 2 weeks after the event occurring, after the tax drain actually occurs. And this is what both those distributions look like on your screen. There's nothing statistically significant here. Same thing with the 4-week return, exact same thing. Really nothing statistically significant. I've got at this from many different angles in the past, and my conclusion is it's very difficult to use the corporate tax drain as a kind of pinpoint event where markets might end up stalling out. Also, real quick, just if you want to take a look at the average return for both of those events, you're looking at, in terms of all the events occurring going back to 2000 and I think about 2005, 0.1% difference in the return of the S&P on the 2-week, essentially the same on the 4-week. Nothing statistically significant. Now, here's the thing. Could a tax drain potentially cause some turbulence in markets? Absolutely, but I just don't think it's a linear event, right? I think there are other variables that you have to take into consideration. Recent momentum in markets, where the reserve situation, where balance sheet operations are at in banks. There are obviously many factors, many variables at play here. And so what could happen is, if there is the window for selling, or there's an opportunity for selling, that maybe the tax drain that occurs could exacerbate selling that might already be occurring at that moment. And that is where I think we might be at. And I'll go ahead and explain why I think we might end up running into a bit of a sell-off here in markets coinciding with that tax drain season. And it all has to do with the options expiration cycle. I've gone over this plenty in the past, so I won't go into too much detail, but suffice to say, dealer hedging in the options market really comprises the majority of price swings that we see day in, day out. Those flows are in the billions, tens of billions, hundreds of billions at sometimes day in, day out. And that is oftentimes why, as you head into OpEx week, and so for the month of June, it's going to be next week, you see a heavy compression of price. We saw that play out in May. We're now seeing it play out in June. You see a compression of price as we head into OpEx, and it oftentimes happens at the largest build of options gamma. I'll show you that in a second. Of options gamma at that strike price, you'll see a compression of volatility, you'll see a compression of price variance, and then you finally hit OpEx week and the days following OpEx, and that is when you see a spike in volatility. That's exactly what we saw play out in May, and I think we're probably setting up for a similar situation in June, where we get a brief sell-off around the options expiration period, and it might get exacerbated because we are getting the tax drain at that same time. To visualize this a little bit more, I'm going to pull up, and this will be a bit of a preview of a tool Bijou and I are piecing together. We're about to publish this very soon for our Patreon members. Of course, all this data already we review twice a week over on Patreon, but this will be an interactive tool for traders and investors to go ahead and utilize to see in real time where certain levels are at, and using this in conjunction with our deep MMT tools really gives us a heads up in terms of where price is at. So what we would look for then is the total gamma, the build at each individual strike price. We want to look at the highest build. Right now, 4,300 is that largest build without a doubt. So no surprise that 4,300 is polling price to it, that 4,300 strike on the S&P, polling price to it. And that is where we are finding a bit of a ceiling, a bit of a well, if you will, where price gets captured at that point at 4,300. So big pull to 4,300. You can also see at the gamma exposure as well. You're looking at about 4,350, where we're peaking at the gamma exposure curve. In other words, that would be likely where we could peak to momentarily before we get pulled back down to that kind of magnet of 4,300. So I would expect at the absolute peak, 4,350, 4,357 to be exact, but this is a little dynamic. It can change, but about 4,350 will likely be the peak heading into next week's OpEx, and 4,300 being kind of the pin zone where price will fluctuate around again as we head into the end of OpEx next week. Now, a couple big things to keep in mind. all bets are off when major macro announcements occur. Next week, we have the FOMC. I believe we even have CPI, so we're going to have some major data coming out. That could shake things up. So we're going to want to check this data out after those events occur. But heading into Friday, all things being equal, we would expect price to stay relatively compressed and relatively pinned to these zones. And then what happens is this hedging activity, these gamma builds begin to fall off the dealers' books, and that is when there is a window of opportunity for a little volatility to spike. There's not the pinning effect that this gamma build has on markets. What ends up happening is we can see a little fluctuation in price as new options positions are made for the next OpEx cycle. Again, about a third of the overall hedging activity will fall off. We'll get a bit of a reset, and then likely after that we'll reestablish the bullish trend that has been emerging here for the last few months. So I think this is the key observation that needs to be made that can really give us some insight in terms of what's going to happen heading into the second full week of June OpEx, and then also some major macro data. All that being said, look, I apologize for the clickbait thumbnail and the clickbait title, but I don't think things are going to get terribly bearish here. I really think we are continuing to see some very strong underlying macro flows, and we can continue to expect, at least with a relatively high probability here, that we continue to see a climb higher in market in the overall markets here. So that's what I have for tonight's market recap. Hey, if you're not subscribed yet, get subscribed. Also, if you're an active trader, active investor, patreon.com/MMT macro trader, where you can find all my updates, all my real-time analysis through an applied MMT macro lens. Otherwise, that's all I got for tonight. Good trading, everyone. We'll see you next time. Bye-bye.